Let's get into monetary policy. So monetary policy is going to involve managing interest rates and credit conditions that are going to influence the economic activity that is happening in the economy. The most common monetary policy tool that we have is the open market operations. So this is where the central bank is going to be buying or selling treasury bonds, and this is going to influence the quantity of money, and because of that, that's going to change the interest rates, and because interest rates change, that's going to change investment, that's going to change how much money you save, that's going to change how much money the bank's going to save. So the Federal Open Market Committee, these are the people that are going to be actually changing the amount of bonds that we're buying or selling. So they are 7 members from the Board of Governors from the central bank, the Fed, so those Board of Governors there, and 5 voting members from the regional banks. So out of those 12 regional banks that we talked about, 5 of them are going to be a part of this committee here, and they're the ones that are going to decide, does the economy need more money or less money? So other options that the central bank has or the Federal Reserve has in order to change monetary policy, that's going to include the federal funds rate or the discount rate or the required reserve ratio. Remember, the required reserve ratio was just how much money the banks are required to have, such as 10%. So if you deposit your money, let's say $100 in the bank is required to put 10% of that into their reserves, so $10, okay? And then they can make loans with the rest of it. So we'll talk about how changes to these factors will change the money supply. The first one is going to be open market operations. If we buy bonds, this will increase the money supply. So how this happens, right, is the central bank is going to buy the bonds from the bank. So the bank has some bonds that they're trying to earn money on from the government, okay? Or, they're trying to basically use some extra cash that they have in order to make more money to make more loans with, okay? So if the bank has bonds in their reserves, such as this assets right here, right? They have $120 worth of bonds in the bank. The central bank, the Fed, could buy these bonds from this bank here. All right, how they're going to do that is they're going to literally just create money out of thin air. They're going to say, I need $20. So they're going to take $20 out of the air and they're going to give it to the bank. And they're going to say, hey, here you go, here's $20. I want to buy your bonds. All right? So what happens here is this bank is going to get $20 extra to their reserves because the central bank is giving them $20, and then the bank is selling their bonds. Okay, so the central bank is buying bonds. They are literally creating money to put into the bank. All right, the central bank is the one that's buying the bonds here. Okay? Notice that we are adding 20, subtracting 20, so we're still in balance here. If you were to add up this total here, it would be 460, and that equals the other side as well. So we are still in balance. So what happens here is the bank now has $60 worth of reserves. How many deposits do they have? They have $400 worth of deposits. They are required to have 10%. They have $60. They're required to have 40. So that means they have 20 extra. What can they do with this 20 extra? They can make loans with it. Okay? So because they have loans, right, that is money going into the system and having the money multiplier effect. All right? Notice here that in order for the central bank or the Fed to increase the money supply, they have to figure out a way to put the money in. They can't just leave it on the side of the road and hope someone grabs $20 billion. They need to give the money to banks. And how they do that is they buy the bonds from the banks and they say, hey, give me the bond, here's money. use this money to make loans with. Because when we have loans, we can increase the amount of money, in the circular flow, which increases the GDP. Okay. So this is the open market operations, where buying bonds increases the money supply. Let's talk about selling bonds. Okay. So selling bonds will decrease the money supply. Here's how this works. We have this bank here, okay, and the central bank is going to say, hey, I'm going to sell you these bonds, okay, where you could earn some interest on them, okay, because they're treasury bonds, you can earn an interest rate on it. So go ahead and buy these from me. So the central bank is selling bonds, okay? They're selling bonds to get money, right? So look at this bank here. This is their original balance sheet. The central bank is going to say, hey, if you give me money, I'll give you bonds. So I'll sell you bonds. So the central bank is like, oh, okay, cool. I'm sorry. So this bank is going to say, oh, cool. I will take those bonds. I will buy $30 worth of bonds. Okay. So they're going to take reserves, okay, and give it to the central bank. And they're going to take that money to buy the bonds with. So now the central bank is selling bonds, collecting money, and so this bank is now getting $30 worth of bonds. Okay, but here's the issue. Look at the reserves now. As you can see, the reserves, because they took $30 out of reserves to buy these bonds back, they have $10 in reserves. How much are they required to have? Well, they have $400 in deposits, which means they are required to have $40 in the reserves. So what happens here is they need to call back some of the loans. So they need to call back some loans. Okay. So what they'll do is they actually make less loans in this case. So they're taking money from loans and turning it back into reserves. So this bank is taking money out of the circular flow to put it in reserves. Because there's less money out in the circular flow, GDP will decrease. The money supply will decrease. Okay? We're having less money because of the selling bonds. So when the central bank is selling bonds, the banks are going to be taking money out of the circular flow to get the bonds. And that is how we decrease the money supply. Anytime you see selling bonds, we are decreasing the money supply. The other option we have is changing the reserve requirement. Remember, so the reserve requirement is that percentage of the bank deposit that you are legally required to hold in cash at your deposit, in your vault. Okay? The greater the reserve requirement, the more money you have to have in your vault, the less money you can make loans with. Let me show you. If we put in $400, and let's say the reserve requirement is 10%. This means our required reserves are $40, so we can make loans of $360. If the required reserve is 20%, this means our required reserves are $80. This means we can make loans of $320. So because you're making less loans, right, the money supply is going to be decreasing. Okay? So the greater the reserve requirement, less the money available to lend out, versus a smaller reserve requirement will actually lead to a greater amount of money available to lend out. Very rarely does the Fed use this in order to change the money supply. The Fed rarely uses large changes in the reserve requirement to execute monetary policy. The pandemic was an exception for obvious reasons. So basically, we did have to change the reserve requirement because of what was going on during the pandemic. We had a lot of issues there where, you know, nobody was buying anything. So that really changed how much money supply we need. Okay? So changing the reserve requirement is a tool. It's very rarely used though. Increase in the reserve requirement decreases money supply. Decreases in the reserve requirement increases the money supply. We can also change the discount rate. The discount rate is the interest rate charged by central banks on loans to give to other commercial banks. So basically what's happening here is that if I needed a loan and I'm a bank, I could go to the central bank and I say, hey, can I get a loan from you? And they say yes. I can get a loan from the central bank and I have to pay what is called the discount rate. So basically, if, let's say, I have a T account, so I have my assets and I have my liabilities, okay, and my demand deposits are $500. I have required reserves of 50 and I have loans of 450. Okay, so I'm in balance. Everything's good. But the thing is that if someone were to take out $100, like Joe comes into my bank and they say, hey, can I get $100 out of my deposits? I'm like, yeah, sure, no problem. So now my demand deposits are $400. Okay, but I had to give him some of this money. I had to give him my $50 in the bank, right? But I need the $50 from somewhere else, right? I can't call these loans in right now. I could call the central bank and say, hey, I need $50 right now. So I could borrow $50 from the Fed. So now I can pay 50 and 50. I can now pay him back his $100. Okay? So what I'm going to have to do is I have to change how much loans I have, right, to where I can be in balance again. But in order to pay back this person, I could borrow money from the central bank. And if I'm borrowing, I do have to pay the discount rate. Okay, so I do have to pay the discount rate. If the central bank is raising the discount rate, making it more expensive to borrow money, this is going to reduce their my borrowing from the Fed. Basically, if it's more expensive to borrow, I'm going to be a little bit more cautious of how many loans I make. I probably am going to keep $200 in my reserves just in case someone wanted to take out $100 to where I have it. I have the $100 to give to somebody, okay? And I don't have to borrow from the Fed. And if I don't have to borrow, I don't have to pay the discount rate. But what happens here is if we are increasing the discount rate, this means I'm having more in reserves, I'm having less in loans. So therefore the money supply is going to fall. Okay? And then if the money supply is falling, this is going to make the interest rates rise. I'll show you why that happens in a second. If the central bank lowers the discount rate, it charges the banks. The process is going to work in reverse. So basically, if it's cheaper to borrow from the Fed, what you'll do is you'll just make a ton of loans and you'll just borrow money from the bank to make loans with, because you can make more money in the loans than you could when in borrowing money from the bank, from the Fed. So why not? Why not borrow to make loans with, to make more money to pay with? All right. So because you're making more loans with a lower discount rate, it's going to increase the money supply. The next thing is going to be changing the federal funds rate. So the federal funds rate works the exact same way as a discount rate. However, this is the interest rate charged to other banks for a very short-term loan to cover the lack of reserves. So same thing that we just talked about, where the Fed, where you can borrow from the Fed, imagine doing that same thing, but with another bank. Okay, so this is where we are paying the interest rate to another bank because we're borrowing money from them. It's usually an overnight loan. It is used as a target rate for the Fed. So basically, instead of borrowing from the other bank, instead of borrowing from the Fed, you can borrow from another bank. Okay? We hear about the federal funds rate all the time in the news. This is the rate that is used for the Fed to target inflation and unemployment. When they change the federal funds rate, this is going to change interest rates throughout. The Federal Reserve has, since 1995, established its target federal funds rate in advance of its open market operations. Basically, they're going to be changing the federal funds rate in order to influence interest rates across the country. Increasing the federal funds rate will make it more expensive to borrow from other banks. Because it's more expensive to borrow from other banks, you hold more reserves, so you don't have to pay the loan, so you can have more in reserves. You don't have to pay the interest rate. But because you have more reserves, you have less loans. Because you have less loans, this is a decrease in the money supply. If we decrease the federal funds rate, it makes it cheaper to borrow from other banks. Therefore, you would borrow more money from other banks because you want to make as many loans as you possibly can to make more money, and then you can borrow from other banks to make that happen, and then you just pay the interest rate because it's cheap. You pay the interest rate, make more loans, make more money supply. Okay? So that's what happens when you decrease the federal funds rate, is you can increase the money supply. And the last thing is going to be changes to the interest earned on reserves. So just like you can save money at the bank to earn interest on your savings, the bank can also earn interest on their reserves by saving it at the central bank. Banks can also earn money by depositing their reserves at the Fed, and they can collect an interest rate. Earning more money for reserves by increasing the interest rate earned on these reserves means that the banks are going to take less loans, more reserves, put the reserves at the Fed. The Fed is then going to pay them an interest on that. So what happens here is because they're having less loans to save more money, this decreases the money supply. When the Federal Reserve makes an announcement about a change in the federal funds rate, this could make changes to interest rates throughout the country. So if this Federal Reserve increases interest rates, such as the federal funds rate, this is going to increase the interest rate earned on reserves. So the bank is like, oh, I can earn more money for saving. I'm going to have less loans and put more in savings. If I'm having less loans, this decreases the money supply. If the Fed were to decrease the interest earned on the if the Federal Reserve were to decrease the interest rate earned on reserves, then the banks are like, whoa, I can make more money if I make loans. So I'm going to take those reserves and make loans with them. And because the interest rate decreases over here, this is going to increase the money supply over here. So that's changes to the interest rate earned on reserves. Those are our tools. In the next video, we'll talk about how we can actually use these. I'll see you there.